Thank you for joining me. I'm Alex, and I have rearranged things, so I hope that I don't get tripped up. Also, let me know if you like it in the comments. So today we have IBM, which stands for International Business Machines, but that was too long and didn't fit. It was covering half of this part, and I don't like it. So IBM makes business machines these days, mostly servers, and also some, but not very much, consumer hardware. But their main focus is big servers, mainframe kind of things. Current stock price $118.61, which gives them a market cap of $106 billion, which was significantly higher the day before because they just announced earnings and things didn't go so well, apparently. Revenue $73.6 billion, earnings $5.6 billion, which is significantly down, which kind of probably explains why they're down so much. But that gives them a PE of 19 with a forward PE of 10. Forward PE is pretty nice. Current PE, not so much, but like 4 years ago, they had pretty much the same earnings, slightly lower, and then it went up to 9 billion. So if they can get back there, pretty decent. Dividend yield 5.5% with a payout ratio of 106%. Again, payout ratio is not that much of a problem because if they get back to 9 billion earnings, the payout ratio would be 55, 60ish percent. So not that big of a deal. They can certainly handle it. Total assets $156 billion, total liabilities $135 billion, which gives them total stockholders' equity of $20.6 billion. And the 106% dividend payout ratio means that they lost some money on the balance sheet. Again, not a huge deal, $20 billion, pretty decent, also kind of in line with the market cap of 106 billion, but I would like a little bit more, but it's not bad. Risk factors, kind of the Google problem that companies are building stuff based on consumer hardware, which IBM doesn't really do, and that could be a problem in the future when more companies, Facebook, maybe even like Netflix, all the other major companies actually use consumer hardware, and it catches on in the small-ish business sector as well. That could be a problem. Overall, I don't think that it's that much of a problem because buying things off the shelf and having IBM maintain them is going to be far better for companies that don't have a whole department dedicated to making sure their servers are running. So overall, revenue growth being negative, obviously a problem. So growth investors are out for so many reasons. I don't see too much long-term growth, definitely not growth investor type growth. So growth investors are going to be out. For a dividend investor, I think this stock looks extremely interesting. With a 5.5% dividend yield, especially these days, and a payout ratio which, if things go back to the 9 billion and they had in profits, the payout ratio would be pretty decent. So overall, I would say that dividend investors should really look into a stock like this. Very stable company. Even if there is a slow decline, it's going to be a very slow decline, and I think it's going to do reasonably well in the future as well. For a value investor, the balance sheet doesn't look great with the assets to liabilities ratio of not even 1.5. The growth being negative is a problem. The dividend is a nice bonus, and the forward PE being 10 is going to be very interesting. So if you're a value investor, I think that you should be looking into this company as well. I think that reading more about their risk factors and how things are going to be in the future is going to be really interesting, and I personally think that I'm going to invest in this company because I don't think I can pass up a forward PE of 10 and a dividend yield of 5.5%, especially after they just dropped 10%. So I'm going to assume that I'm going to stick a little bit of money in this. That's it for me for today. If you liked this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.